You did the hard part. You actually started investing. You opened an account, you're contributing every month, you check the balance occasionally, and it's going up. By almost every measure people use to judge whether someone's doing it right with money, you are. And there's a real chance you're still quietly losing somewhere around $200 a month, maybe more, without a single warning ever showing up in your app, without a single red flag, without anyone ever telling you. Not because you did anything reckless, because of a number sitting in your account settings that almost nobody ever actually opens. One that's been quietly working against you since the very first day you signed up. My name is Nick, and I spend way too much time pulling apart the parts of investing that look completely fine on the surface, while quietly costing people a fortune underneath it. Today, we're talking about the mistake that doesn't feel like a mistake at all, because your app never tells you it's happening. Your balance still goes up every month, and everything looks exactly like it's supposed to, right up until you actually sit down and do the math on what supposed to was really costing you. Hit subscribe if you want more of this kind of straight talk breakdown instead of vague budgeting tips. Let's start with the myth, because this is the assumption that's quietly costing new investors a genuinely staggering amount of money. The myth is this: if my brokerage app is letting me buy something, it must be a reasonable choice, because surely a legitimate platform wouldn't let me overpay for no reason.
That feels true. It sounds like basic consumer protection logic. The same logic that makes you trust a grocery store isn't selling spoiled milk, or that an airline wouldn't sell you a seat that doesn't exist. Except investing platforms operate under a completely different rule. Every fund on your app is legal, regulated, and fully disclosed. Nothing about a 1.2% expense ratio fund sitting right next to a 0.03% expense ratio fund is a mistake on the platform's part. The platform's job is to give you options. Understanding which option is quietly draining your returns is entirely on you, and almost nobody ever checks. Here's the mechanism, and once you see it, you'll never unsee it. It's called the expense ratio, and it's a small percentage, usually somewhere between 0.03% and 1.5%, that gets deducted automatically from a fund's assets every single year to pay for the fund's operating costs. Here's the part that makes this so easy to miss. This fee never shows up as a transaction in your account. There's no line item that says fee charged. It's already baked into the fund's daily price before you ever see a number, deducted quietly from the fund's net asset value behind the scenes. Your balance still goes up. When the market goes up, it just goes up slightly less than it should every single day, forever. And there is nothing in your app's interface that flags this for you. No push notification, no monthly summary line, nothing that distinguishes this cost from simple, ordinary market movement.
Let's stress test this, because I don't want you thinking this only applies to one specific set of assumptions. What if your fee difference is smaller, say 0.03%, versus a more modest 0.50%, the kind of fee you'd find on a lot of moderately priced, actively managed funds, rather than the more expensive end of the spectrum? On that same $500 a month, 30-year scenario, the gap shrinks to roughly $115,000. Still a genuinely enormous number for a difference that felt small enough to ignore at the time the fund was selected. What if your time horizon is shorter, say 15 years instead of 30, because you're already further into your career? The gap on that same 1% fee difference shrinks to roughly $48,000, smaller in absolute terms, but still a meaningful amount of money, lost to a number most people have never looked up. The pattern holds, regardless of the exact inputs. Higher fees cost more, longer time horizons make the cost worse, and the number is always bigger than it feels like it should be when you're staring at a percentage with a decimal point in front of it. Here's where the $200 a month framing actually comes from, and it's worth walking through directly. If you spread that roughly $210,000 gap evenly across the 30 years it took to accumulate, it works out to an average of almost $600 a month in lost growth by the later years. But if you look specifically at what's happening in a typical middle-of-the-journey year, once your balance is meaningfully large, but you're still decades from retirement, the fee difference
alone is quietly costing a fairly typical investor somewhere in the neighborhood of $200 a month in growth that simply never happens, silently, invisibly, with no notification, no warning, and no line item any year in your account, month after month, for years, without a single indication that anything is different from what it should be. Let's talk about why this particular mistake is so easy to make, because it's not about being careless. According to research cited by Fidelity's own investing team, a typical investor shopping for a fund is far more focused on historical performance than on the fee, because a strong past return feels like it matters more than a small percentage buried in a prospectus.
That instinct isn't unreasonable. It's just backwards. Decades of data consistently show that the majority of actively managed funds fail to beat their comparable index over long time horizons once fees are factored in. Somewhere in the range of 90% of them underperforming over 15-plus year periods, according to current industry research. You're not just paying more for a chance at better performance. You're usually paying more for a fund that's statistically likely to underperform the cheaper option sitting right next to it on the same app. There's a specific reason this particular fee stays so invisible, and it's worth naming directly. Almost every other cost in your financial life shows up as a distinct transaction. Your rent leaves your account as a single withdrawal you can see. Your subscription charges appear as individual line items with dates attached to them, easy to spot if you ever scroll through a statement. An expense ratio does none of that. It's baked directly into how the fund calculates its own daily price, deducted continuously and invisibly before the number ever reaches your screen. You never see a charge labeled fee. You just see a slightly smaller number than you would have otherwise seen, forever, with no moment that ever draws your attention to it. This is precisely why a cost that's completely disclosed on paper still manages to go almost universally unnoticed in practice. Disclosure and visibility are not the same thing, and fund companies are only legally required to provide the former. Here's a second version of this mistake worth naming directly, because it's sneakier and shows up even among people who think they've already avoided the fee trap. It's called fake diversification, and it happens when someone buys several different funds, thinking they're spreading their risk, without realizing those funds overlap almost completely underneath the surface. Picture someone who buys 4 separate ETFs, a total market fund, an S&P 500 fund, a growth fund, and a tech-heavy fund, feeling appropriately diversified across 4 different tickers. In reality, the same handful of mega-cap companies, the largest tech and consumer names in the market, sit inside the top holdings of all 4 funds simultaneously. That investor can easily end up with 40% or more of their entire portfolio concentrated in the same 10 stocks, just spread across 4 ticker symbols that each carry their own separate expense ratio. It feels like diversification. The underlying exposure says otherwise, and in a lot of cases, the investor is now paying 4 separate fee structures to hold what's functionally one concentrated bet wrapped in the appearance of variety. This particular mistake is worth taking seriously because it compounds the fee problem rather than existing separately from it. Someone holding 4 overlapping funds isn't just paying 1 expense ratio, they're paying up to 4 on assets that substantially duplicate each other, sometimes without realizing that 2 of those funds are 70% identical underneath their different ticker symbols and different marketing names.
Even if each individual fund carries a perfectly reasonable-looking fee on its own, the effective cost of the overall portfolio ends up higher than necessary because the investor is essentially paying multiple management fees to achieve exposure that a single, broader, cheaper fund could have provided on its own. The fix here isn't necessarily to hold only one fund forever. There are legitimate reasons to diversify across asset classes, geographies, or bond exposure that genuinely don't overlap. The fix is simply checking whether your funds actually diversify you, or whether you've paid extra to recreate the same bet several times over. Let's make this concrete with 2 people, because the contrast is where this really lands. We'll call them Maya and Ben. Both 26 years old, both start investing the same month, both commit to putting $400 a month into their brokerage account, and both genuinely believe they're making a smart, responsible decision by starting early, which, to be clear, they both actually are. Maya does a small amount of research before picking her fund, and ends up in a broad market index fund
charging a 0.04% expense ratio, close to the cheapest option available. Ben, meanwhile, opens an account through a robo-advisor bundled with his bank, which defaults him into a blended, actively managed portfolio, charging a combined 0.95% in underlying fund fees, plus advisory costs. Neither of them did anything that felt reckless. Ben didn't chase a hot tip or panic buy a meme stock. He simply accepted the default option his platform suggested, the same way most people do, filling out the same onboarding questionnaire everyone fills out and clicking through to the pre-selected recommendation at the end of it. By year 10, assuming both portfolios earn the same underlying 10% market return before fees, Maya's account is sitting at approximately $76,600. Ben's account, same contributions, same market conditions, same decade, is sitting at approximately $68,900. That's already a gap of roughly $7,700.
Maya didn't pick better stocks. Ben didn't make a bad trade. He hasn't touched his account beyond letting the automatic contributions run. The entire gap came from one decision made in month 1, checking a single number that most people never think to check at all. Buried in a fund fact sheet, neither of them had any particular reason to open. Let's project this out to year 30, because this is where the fee gap stops looking like a rounding error and starts looking like the difference between two completely different retirements. By year 30, Maya's account, still contributing that same $400 a month the entire time, has grown to approximately $904,000. Ben's account, identical contributions, identical market conditions, has grown to approximately $685,000. That's a gap of roughly $219,000, and Ben never once made a decision that felt wrong. He contributed consistently for 3 decades, which is genuinely the hard part that most people never manage to do at all, showing up every single month, regardless of what the market was doing that day. He just never checked the one number sitting quietly in his account settings that would have told him he was giving up nearly $250,000 for no additional benefit whatsoever. Here's the part that should genuinely unsettle you. If you'd shown Ben in month 1 a projection proving that his fund choice would cost him $219,000 over 30 years compared to a nearly identical alternative sitting one menu click away, he almost certainly would have picked differently. The problem was never that Ben didn't care about his financial future, and it was never that he lacked discipline, since he actually out-contributed plenty of people who never invest consistently at all. The problem was that the fee was completely invisible in the moment the decision was being made. The interface simply presented both options as equally valid choices, because from a regulatory standpoint, they are, and it's entirely on the investor to notice the difference. Let's look at one more version of this at a smaller scale, because not everyone watching has been investing for a full decade already, and I don't want this to feel irrelevant if you're just getting started. Consider someone we'll call Priya, 22 years old, contributing a much more modest $150 a month into her very first investment account. She, like Ben, accepts the default fund suggested by her platform's onboarding flow, which carries a 0.80% expense ratio, without comparing it against the cheaper index option, available 2 clicks away on the exact same app. After just 3 years, the gap between her actual balance and what she would have had in the lower cost alternative is still relatively small, somewhere around $180, easy to dismiss as not worth worrying about. But if that same 0.80% fee difference continues uncorrected for the next 27 years, reaching a full 30-year horizon on that same modest $150 monthly contribution, the gap grows to roughly $63,000. The size of your current contribution doesn't determine whether this mistake matters.
It only determines how large the eventual number turns out to be, and the earlier it gets caught, the smaller that number stays. This is worth sitting with for a second, because it reveals something important about how these platforms are designed. Nobody at your brokerage or robo-advisor is lying to you. The fee is disclosed, technically, buried in a prospectus document that almost nobody reads before clicking confirm. The entire mistake happens in the gap between
technically disclosed and actually noticed. And that gap is exactly where a huge percentage of new investors lose money every single year without realizing it's happening. Now, before we get into the fix, it's worth naming the specific warning signs that you might already be inside this pattern, because it rarely announces itself, and most people carry at least one of these without ever realizing it. Warning sign 1. You genuinely don't know off the top of your head what the expense ratio is on the funds you currently hold. If someone asked you right now and you couldn't answer within a few tenths of a percent, that's a strong sign you've never actually checked. Warning sign 2. You selected your current investments primarily based on recent performance, a fund that did really well last year, rather than comparing costs against similar lower fee alternatives. Warning sign 3, and this is the one that catches the most people. You're invested through a bundled product, a robo-advisor, a bank's in-house investment service, or an employer's default 401k option, and you accepted whatever the default selection was without ever looking at what else was available on the same platform. There's a fourth warning sign worth naming specifically because it directly connects to the fake diversification problem. You own more than 2 or 3 separate funds and have...
If you genuinely don't know whether your 4 different funds are secretly all holding the same handful of companies, there's a real chance you're paying multiple layers of fees to hold what's functionally one concentrated position. There's a 5th warning sign worth adding, and it's the one most closely tied to how these fees get chosen in the first place. You've never compared the fee on your current fund against at least one alternative available on the same exact platform. This is different from simply not knowing your fee, because plenty of people can technically recite their expense ratio if pressed, but have never once looked sideways to see whether a cheaper, comparable option exists right next to it. Knowing the number in isolation doesn't help much if you've never checked whether it's actually competitive.
There's a third, smaller fund quirk worth mentioning while we're on the topic of naming this pattern, and it comes back to something we touched on earlier: tracking error, the gap between what a fund is supposed to track and what it actually delivers. Funds holding harder to price assets, emerging market bonds, illiquid small caps, niche commodities, or thematic sectors can quietly cost you more than the sticker price expense ratio suggests, because the tracking error itself functions as a hidden additional cost layered on top of the disclosed fee. If you hold anything more specialized than a broad market fund, it's worth a quick look at how closely its actual returns have tracked its stated benchmark over the past several years. Now, let's deal with the objections, because I already know what some of you are thinking.
Objection 1. A 1% fee doesn't sound like that much. This feels like you're exaggerating. We already walked through the actual math on this. A 1% expense ratio versus a 0.03% expense ratio on a $500 a month contribution over 30 years produces a gap of roughly $210,000. That's not an exaggeration. It's a direct calculation using standard compound growth assumptions, the same math your brokerage app itself uses internally to project your own account. And it's specifically why financial researchers describe fee minimization as one of the only genuinely guaranteed ways to improve long-term returns. Because unlike market performance, which nobody can control, the fee is knowable in advance and entirely within your control. Objection 2. Higher fees exist because those funds perform better. That's what I'm paying for. This is the exact assumption that current industry research keeps directly contradicting. The overwhelming majority of actively managed funds fail to beat a comparable low-cost index fund over long time horizons once fees are factored in. And that gap tends to widen the longer the time horizon gets, not shrink. You're not reliably paying for outperformance. In most documented cases, you're paying extra for a fund that's statistically likely to underperform the cheaper alternative sitting right next to it. Objection 3. I use a robo-advisor specifically so I don't have to think about any of this. Isn't that the whole point? Robo-advisors can genuinely be a reasonable choice, particularly for people who know they won't manage a portfolio themselves.
But not having to think about it and not knowing what you're being charged are two completely different things. Most robo-advisors publish their fee structure clearly if you go looking for it specifically. And the fix here isn't necessarily switching away from a robo-advisor. It's spending 5 minutes confirming the specific fee you're paying and comparing it against what a basic self-managed index fund portfolio would cost. So you're making an informed choice rather than an accidental one. Objection 4, and this one's worth taking seriously. I already picked my funds years ago. Switching now might trigger taxes or fees of its own. That's a completely legitimate concern in a taxable brokerage account. And this isn't a video telling you to blindly sell everything today. This video was never meant to suggest you did something wrong by starting. Think back to Maya and Ben one more time. Same age, same monthly contribution, same market conditions for 30 straight years. One of them ends up with $904,000. The other ends up with $685,000. Neither of them ever made a single decision that felt reckless, and neither of them ever saw a warning telling them something had gone wrong along the way. The entire $219,000 gap traces back to one unexamined number sitting in a settings menu on the very first day either of them opened an account. It's meant to close a specific 5-minute gap between what you're currently paying and what you could be paying for functionally the same exposure to the market. That gap, left unchecked, is worth roughly $200 a month in a typical growing portfolio, quietly, invisibly, for decades, without ever once showing up as a warning in your app. It's not a dramatic mistake. It's a quiet one, sitting in a settings menu